Hello, this is Brian Resney, President of Resney Wealth Management. As we enter January 2026, let's discuss the U.S. economy outlook, focusing on GDP growth and sectors poised for earnings expansion to drive stock appreciation, the impact of flat or declining earnings on share price, and why falling interest rates and oil prices could shape the year ahead. U.S. GDP growth outlook. Forecasts are looking at about 2 to 2.5% GDP growth for this year, 2026. Some optimists are looking for growth rate in the 5% range. I realistically think that the U.S. economy most likely will have GDP growth in around the 3.5%+ range for 26. If that can happen, the overall U.S. economy will be on fire, positive, and I firmly believe that gives us great opportunity for outstretched returns, especially in the equity market. Growth will likely broaden, supported by AI investments, tax cuts, and easier financial conditions, deregulation. The risk of tariffs could temper early momentum in the overall economy and the market. Sectors with earnings growth potential. Earnings growth is the key to share price appreciation. If earnings are going up, profits, that signals good fundamentals, and those stocks often do well. Stocks in the AI, infrastructure, and cyclicals often rebound. Information technology is one area that we like, and we do have quite a bit of money invested in that. Projected for double digits earnings growth in the low 20% range. The Magnificent Seven, by the way, is going to have about estimated 45% of the earnings growth of the whole S&P 500. We own those currently. We are looking for outperformance in the U.S. equity market and underperformance in emerging markets and international, which those two we do not own. Industrial materials, earnings growth could bolster when the tariffs fade. Financials and consumer discretionary are areas that could be hotspots. Why flat or decrease in earnings hurt share price? Let me tell you a quick story. Earnings growth often pushes share price higher. Decrease in earnings push share price lower. Not to pick on UPS stock, but I've had a few clients over the years who worked for UPS, overloaded the boat unfortunately on UPS, and never took our recommendation to sell and lock in profits on UPS. Well, it's sad to say, but if you look at the last 5 years of UPS stock, the earnings have been going down, down, down. Exactly what I'm going to discuss with this particular bullet point. If you own stocks that have flat or decrease in earnings, your stock price is going down. Guess what, folks? UPS stock is down almost 50% in value in 5 years. That's hideous, but if you would have listened to our recommendation, you would have been a happy camper in our opinion. Flat to decreasing earnings are not a place to be, and those are places at our firm we avoid. Historically, sectors with contracting will underperform every single time. As we've seen with energy last year, remember, we sold our energy holdings in 2024. 2025 was not great, and ultimately I think energy is not going to be that great in the future. Interest rates and oil trends though. I think the Fed is likely to cut interest rates 1 or 2 more times in 26, bringing the Fed fund rate down to 3 to 3.5%. Lower rates, reduce borrowing costs, bolster valuations. Obviously this is positive for the U.S. economy, consumers, and the overall market. I ultimately think oil prices are going to decline to the $50 to $55 oil per barrel price. Why is that? Surplus supply. Folks, think about Venezuela and Iran, who have been offline for years, coming back online maybe sometime this year or maybe next year. Oil is going to have a huge glut. Oil prices come down. Who does that benefit? Every single consumer, every single business. In closing, in summary, 2026 offers opportunities in AI fuel tech, industrials, and healthcare for earnings growth driven gains, and moderate GDP growth and easing rates on oil. At Resney Wealth Management, we're positioned portfolios accordingly to these numbers and these stats. And if you're a client of the firm and you have any questions or concerns, please call the office. We always want to answer your questions and your concerns. Remember, refer this video, pass on this video to your friends and family so they can get the same high quality education you get. Lastly, we've had a number of clients ask about our new client minimum of $2 million. Yes, our new client minimum is $2 million to become a new client, but if you're an existing client, it doesn't affect you. What about referrals, they often say. So think about this. If you refer a friend or family member to Resney Wealth and they don't have $2 million, we often will make an exception. Remember, we always like working with nice people. So even if your friends and family are under the $2 million, refer them. Let us talk to them and see if we can help them and make a good exception so we can have another high quality client like you and get them moving in the right direction. Don't accept mediocre advice and set it and forget it. Unfortunately, a lot of your friends see that all the time. Resney Wealth Management is substantially different. We are a fee-only fiduciary money manager. Have yourself a safe and profitable day.